Yeah, we're getting Chipotle earnings, fourth quarter earnings per share coming in way below expectations. Or I should say way below what they did year over year. Fourth quarter comp sales up 15.2%, beating estimates of 14.8%. Fourth quarter revenue up to $2 billion, beating estimates of $1.96 billion. Fourth quarter operating margin coming in below estimates, 8.1% versus estimates of 9.88%. Fourth quarter adjusted EPS coming in at $5.58. So that above estimates of $5.28.
Yeah, comp sales, always an important metric, up 15.2%. So that's a beat, 14.8. This is a company that has pivoted big time over the last couple of years, moving aggressively into digital. They're also seeing 2022 new restaurants, 235 to 250. The estimate was 231 remain. So continuing to grow.
And just real quickly, I mean, in the release, they talk about some of those inflationary pressures. They specifically single out beef and freight. And then they say, Tim, to a lesser extent, avocado costs, saying that that's actually been more than offset by menu price increases.
Right.
Pricing power with that guac.
Which is
Bring
something.
back cauliflower rice.
All right, let's see what Mike Halen has to say. He covers the restaurant group for us here at Bloomberg Intelligence. He's senior restaurant analyst at BI. So Mike Halen, the numbers just crossing. We're seeing shares of Chipotle rally big time in the after hours, up more than 6%. What jumps out at you?
Yeah, I think that rally is kind of a relief rally. We've seen the share sell off about 25% since September. I think the street was expecting pretty significant margin pressure, with which we saw. But you're seeing a little bit of a snapback rally. Which really sticks out is that operating margin at about 8%. That's significantly lower than management was kind of intimating and what the street expected. And there's going to be a tough time. January is going to be tough because of Omicron, right? I'd expect them to say that hours of operations were kind of cut due to employees being out sick. The restaurant industry numbers we had in January had definitely decelerated a little bit from December. And then we're going to start to lap significant stimulus payments from last year. Mm-hmm. So, with inflation, high single digit food inflation and mid single digit labor inflation stacked on top of it, there's definitely a lot of headwinds here in the next couple of quarters.
Well, I want to go to the pricing power question here, given that wages are getting higher and, of course, the inflationary pressures that the company refers to in its earnings release. How much pricing power does the company actually have to pass those prices on to consumers, or are they absorbing it and getting hit on margins?
Yeah, we're going to have to dig a little bit more into how much of that same-store sales increase was traffic, right? Because that's a good sign. If you can continue to generate positive traffic, that's tells me that they have some pricing power. And with the fact, as strong as their same-store sales have been over the last couple of years, we do think there is pricing power. But to that point, they've raised prices pretty aggressively. There was a double-digit price increase around delivery orders about a year ago. Last year in the fourth quarter, they raised prices again. So they've been aggressive because they do have some pricing power. We'll see, how much they can increase prices with the economy maybe slowing a little bit and consumer spending expected to be down versus last year.
Michael, the mix between the push into digital, meeting the customer where they are at their convenience, and yet in the press release talking about how there can be at least 7,000 Chipotle restaurants in North America. This is up from our prior goal of just 6,000 restaurants, and talking about accelerating unit growth of 8 to 10% a year and really shoring up the real estate pipeline. How are we thinking then about a real estate footprint as well?
Yeah, so what's interesting is they want more sites with Chipotlanes. Yeah. They generate huge AUVs, average unit volumes for the chain, and very attractive returns on investment. The issue with those sites right now is that they're in such high demand. Since the start of the pandemic, quick service has absolutely knocked the cover off the ball, and we're seeing aggressive growth throughout the entire quick service segment. So there is a lot of competition for those sites. Those sites are definitely more expensive than some of the inline and strip center type locations. So, we'll see. But, this isn't a surprise. I mean, as same-store sales increase, that, increases the potential locations domestically here for the chain.